Hi, and welcome to our final market update of 2025. I'm Valerie Leonard, founder and CEO of EverThrive Financial Group. And the year may be wrapping up, but there is plenty to talk about today, including my expert insights that you should consider when positioning your investments for the upcoming year. You may have a sense for how well the market has done this year, but today we're going to examine in some detail which asset classes and sectors have performed best so far in 2025. And I also want to help you understand what my call on this Goldilocks economy actually means. Then we're going to take a look at potential economic trends heading into the new year, and I'll even highlight some updates on the AI front. Let's start off with acclimating ourselves to how markets have recently performed. And we're going to start by looking at asset class performance as of the end of third quarter. The international asset class, which is the red square up in the far right upper corner, was the best performing asset class for 2025. And it's the first time in more than 10 years that the international space has come out on top. Large cap growth also remained strong, coming in with year to date performance of over 17%. And then we saw other top performers like small cap growth up nearly 12%, followed by large cap value up about the same amount. Commodities were up around 9%, and so on. And then in the bottom right hand corner, you'll see that cash was the lowest performing asset class for the year, which isn't a surprise because interest rate cuts really have impacted how much investors can earn on their cash. Now, here's a look back at performance across the major sectors. In the year to date column, you're going to see the positive performance across all sectors and also the S&P 500, which was up 15.89% as of the close of business yesterday, December 16th. Communication services was the strongest sector, which was up 30.35%. Wow, that's huge performance. And then tech was up 21%, industrials were up nearly 19%. Then you saw financials, utilities, and healthcare all up over 13%, materials up over 7%, and then you can see the remaining performance for yourself. And looking ahead, I'm currently projecting that the first quarter of 2026 will potentially be positive for most major sectors, as well as many emerging market economies. But the second quarter is looking a little bit more questionable. So while this is an educated and research-based outlook, it's always important to take predictions with a grain of salt and stay on top of what's really happening in the world around us. That said, let's dive deeper into what's driving this potential outlook. But before we do, this is also an interesting chart worth considering, and it may very well just blow your mind. We can definitely thank Goldman Sachs for this data. So, the 10 largest US stocks, according to this chart, account for nearly 25% of the global stock market. And these companies are worth nearly 25 trillion. And it's interesting to note that 8 out of 10 of these companies are tied to the tech sector. Now, when you really start to dive into this chart and you compare those 10 companies to the Chinese economy shown here in the second bar, you can see that China has GDP of 19 trillion versus these top 10 US based companies with a nearly 25 trillion valuation. So these 10 companies truly dominate the world stock market. And the third bar shows the top 5 US tech businesses, which collectively are worth 17.6 trillion. And that's a figure exceeding the combined GDP of, get this, Japan, India, UK, France, and Italy. Let that sink in for just a moment. All right, next let's look at some more interesting data. According to JP Morgan, this chart shows that both the weight of the top 10 companies in the S&P 500 and these 10 companies' share of earnings relative to the other 490 companies have increased over the past decade. So that's probably no surprise to you. But this also suggests that there are fundamental reasons for the concentration in the market cap. When we zoom in on this data further and we look at the top 10 companies in the S&P 500, we see that they represent 41% of the overall market cap of all 500 companies. And they also represent 32.6% of the earnings results. So this is why so many people are invested in these companies. It's simply very hard to ignore their strong financial positions and earnings growth. And because of this high concentration of just a handful of companies, this is leading many investors to question whether these companies are just a big bubble But thankfully, the fact that earnings are increasing in these companies kind of tells us that the fundamentals are pretty solid at the moment. And we know many of them have tremendous cash on hand with solid balance sheets. So this is a good sign overall, but investors really should still pay attention to any concentration risk within their own individual portfolios. Just wanted to point that out so you can be mindful of it. So there's your recap on the stock market, but let's take a closer look at the economy. Last month, I mentioned that we were in a Goldilocks economy, and this is just a sweet spot where economic growth is steady, inflation isn't too hot, it isn't too cold. And while we've seen a cooling labor market and also softer consumer demand, this has also helped ease inflation a bit. Now, we're still seeing price pressures, of course, due to the impact of tariffs, and consumers are still going to feel the effects of tariff to some extent. But those risks, from an economic perspective, are generally being offset or reduced by other factors. We also expect to see the Federal Reserve hold interest rates steady at a minimum, and further rate cuts are definitely not off the table. So while they did lower interest rates again this month, it's worth noting that the meeting was contentious because the Fed really continues to juggle two very important mandates. It's their job to keep the unemployment rate solid and make sure that we don't see too many layoffs. But they also have to make sure that inflation stays in check. And these two things are really hard to balance at times. But again, they ultimately lowered the benchmark federal funds rate in December by 0.25%, marking this the third straight interest rate cut in a row. And with this change in rates, we saw short-term bond yields come down, which effectively lowered rates on cash-like investments and also short-term bonds. And then at the same time, we saw longer-term interest rates fall at a slower pace. So we'll talk about mortgage rates here in a minute, but before we do, just know that these moves in interest rates create potential opportunities for investors to capture higher yields in high quality, longer term bonds. And for this reason, we're adjusting some of our own client portfolios to more intermediate term fixed income than we have had in recent years. So, what else am I watching in 2026? Well, first of all, be aware that economic data releases will hit headlines in early first quarter, and they're probably going to seem disappointing because of the effects of the government shutdown. We're expecting to see distortions in fourth quarter data, and this is nothing to be concerned about. My belief is probably that the media is going to make it seem more challenging than it probably really is. And my advice is just to ignore the noise around this type of thing. We know that the quarters following a government shutdown have historically been positive since government spending simply gets pushed into the next quarter. It's not like it goes away altogether. And also keep in mind that the next year is a midterm election year, which could lead to higher volatility. This is definitely something to be mindful of. And one of my biggest focuses in 2026 will be on watching the labor market. As long as it remains strong, consumers will continue to spend, and this will help drive economic growth. If the labor market softens at all, I think the Fed will prioritize lower interest rates in favor of stimulating the jobs market. Another area to watch is the housing market. Since mortgage rates have been stubbornly high, it does make sense that they will come down. Just because the Fed is cutting their Fed funds rate, though, doesn't always mean that mortgage rates will fall. So, mortgage rates often tend to be more influenced by fiscal policy, as well as the outlook on inflation and also growth. And so, as I mentioned earlier, short term interest rates have been falling faster than long term interest rates. And while we do expect mortgage rates to continue trending down, if economic growth slows or if we see unemployment pick up at all, that will work to bring mortgage rates down faster. Additionally, 2026 will continue to be impacted by the rerouting of trade across the globe and also the cost of net new goods. Power, energy costs, those are going to remain structurally high most likely, and they're going to be pushed even higher by the energy demands of AI. So there's a lot of volatility around gas and electricity right now. We're going to be watching these areas as well. And then also, gold will likely continue to be a hot topic in 2026 because of deficit spending. Now, last but not least, if there is one question I get almost daily, it's what about AI? And the question to me falls into two categories. How will AI affect the jobs market? And how will AI affect my investments? So let's take a look at jobs first. Charts like these have shown that they can play an emotional impact on, the emotions of investors. We've seen charts like these go viral. And it shows that historically job openings and the growth of the S&P 500 are correlated. But with the release of ChatGPT, the market has grown while job openings have declined. So I just want to pause here and remind you that the correlation is not necessarily the same thing as causation. And there are often many other factors that affect both market growth and the state of the job market. So, for example, the Fed began raising interest rates around the same time that ChatGPT was released. And we were also just coming out of a pandemic era economy with all kinds of distortions in historical patterns thanks to the effect of COVID. So I share this as a reminder to avoid making emotional decisions or even relying too heavily on shorter term data sets that seem to imply a trend may be in place at the same time that other big things are also happening. And as a reminder, I'm here to help you look deeper into the buzz out there so that you can make informed and confident decisions about your money. So if you have questions on this, just reach out. But for now, what we're seeing is that AI is not truly reliable enough to fully replace many job functions. And even a recent report shows that on average, workers whose jobs involve AI are saving less than an hour of work time per day. And then from an investment perspective, it's pretty obvious that AI isn't going away, and there are lots of great ways to invest in this new technology, whether it's owning companies that make the chips, supporting the cloud, developing the software, powering the technology, managing the data, or focusing on ways that we all can become more efficient. But there's still very much a speculative nature to AI investing happening now. And so I advise interested investors to stay diversified. Many AI-based companies do have solid revenue models, and they're backed by well-financed companies, which is one difference between now and if you're comparing to, say, the dot-com boom. But when many startups at that time were getting high valuations without seeing actual revenue, that's not necessarily the same case right now. So there's a simple tip to keep in mind when you're looking at the impact of AI on your investment portfolio. But there's still way too many AI companies out there, and many of them simply will not survive. Technology, we all know, is advancing so quickly, and it seems that there's newer and better options out there. Even when you see these shiny new innovations, every time you turn around, there's something new just that follows right afterwards. So this means that technology will continue to become obsolete quickly, and that the costs associated with deploying these new technologies won't come cheap. So all that to say, I just want to see you take a balanced and a thoughtful approach to investment decision making before making big bets on companies that you've heard about in the news or even at the water cooler. And so you may be wondering, I have this investment account and I really would like an expert to just manage it for me. Make it easy on me. Help me focus on growing or protecting my money. Well, you need to know that this is exactly what we do at EverThrive Financial. We will take an active investment approach based off of your own personal risk tolerance and offer you personalized strategies to help you reach your goals. And we can also help you make rollover decisions for your 401k accounts or for your retirement plans at work, or even those IRAs that may be sitting somewhere not getting the attention and oversight that you deserve. So if you'd like my team and I to evaluate your accounts and recommend an investment strategy that's right for you, just simply scan this QR code and you can schedule an appointment or contact us even at the phone number or the email address shown here. So that QR code will take you to a direct link to my calendar. You can pause this video if you need more time to access this information. And you also may be interested to know that our team offers comprehensive financial planning solutions as well, because we want to help you plan for retirement and more. On that note, I want to take one final moment to remind you to subscribe to our YouTube channel or share this video with your friends. And I want to thank you for being a part of the EverThrive community, whether you're a regular video watcher or a long-term client. All of us at EverThrive wish you a very Merry Christmas and a joyous start to the new year. I will see you again in 2026. Don't forget to schedule your appointment now if you'd like to discuss your investment opportunities heading into next year. And thank you for watching.